Today I have very good news for you. You are about ready to learn the final part of completing the accounting cycle. Yes, my friends, we are almost done, and today's lecture is very short and sweet. So what we've done so far, you guys have learned how to write journal entries, post those journal entries to the T accounts, create a trial balance, and last week you learned how to create financial statements, which is really the big kahuna of what we're trying to do. But to make sure we get everything in order for the next set of financial statements, we need to do something called closing the books. And we're going to prepare certain accounts for the next time period. And certain accounts that we're going to prepare are called temporary accounts. And what we want to do to these accounts is set them to 0. So for example, every year companies want to keep track of their sales. They want to start fresh on January 1st. So that means they need to get that sales revenue account set to 0 at the beginning of the year. Same thing for all of their expenses, because they just want to track their expenses that happened in the current year. So those are examples of temporary accounts, revenues, and expenses that we need to close out and basically get the account to 0 so we can start tracking fresh for the next new year. Other temporary accounts is also known as owner's drawings and as well. Now, these are the only accounts closed. Other accounts like our cash and our accounts receivable and our accounts payable, we do not close them. Those are known as permanent accounts. So we're going to learn a set of new journal entries to how to close out accounts. So the first thing we're going to look at is what's the journal entry to close out revenue. So what we're going to do to close out revenue is the following. Typically, when I look at, and I'm just going to pull up a blank Excel book to illustrate the point here. When we look at the revenue T account, revenue is, and this is a little bit of a review for us, is an owner's equity account, which means it will always go up with a debit and down with a credit, which means it's always going to have a credit balance. So I'm just going to make up a number here, and I'm going to put $10,000 as the balance in the revenue account. And what we want to do is make sure this account goes to 0. So the only way I can do this is by debiting the account. That gives it the only option I can do to get it to 0, because I got to cancel it out, right? So when I'm closing out the revenue account, I'm going to debit the revenue account. In this case, let's just put in the number 10,000. And these are just made up numbers to help it seem a little bit more real. But I got to move it somewhere. That account just didn't disappear. We're going to move it to something called income summary. So income summary is just literally kind of like a holding place, because we can't make that revenue vanish. So we're just moving it somewhere else just as a holding spot for now. All right? So really it doesn't have any significance. It's just, as my accounting high school teacher used to say, and yes, I did take accounting in high school, very, very sad, that it's a holding tank. It's just a temporary holding tank. So by doing this, this allows me to get my revenue account to 0. And while we're at it, let's just make up a T account for income summary. So I debited revenue and I credited income summary. So like I said, excuse me, all I've done is move that revenue to another account. Now what about expenses? So I'm going to create 2 fictitious expense accounts, one called rent expense and let's just do one called miscellaneous expense. All right, so expenses brings down owner's equity, correct? So because expenses always bring down owner's equity, and owner's equity can only be brought down with a debit, they're always going to have a debit balance. So let's say we have a $2,000 balance in rent expense and $1,000 in miscellaneous. Once again, just made up numbers. So when we want to close out these accounts, because beginning of the next year, we want to start tracking our expenses over. So the only way I can close out these accounts to get these to zeros is by crediting each of these accounts. That's the only way I can get the accounts to zero. So everything here in red is the closing entry. But I have to move them somewhere. Just like revenue couldn't disappear, expenses can't disappear as well. So guess what? I'm going to move these numbers over here to income summary. So I'm going to debit income summary for the total of $3,000, so for the total of the expenses. So let's write the journal entry here. I'm going to debit income summary for $3,000. And when I close out expenses, as I mentioned, I can only credit expenses to close them out. Now, I can't just write one big expense and credit it for $3,000. I have to list each of these accounts individually to properly close them out. So I will credit rent expense and miscellaneous expense here for the dollar amounts and move them to income summary. So the sum of rent and miscellaneous is $3,000 for $3,000. All right. So here's the nice thing. Although these numbers are going to change, you're always going to debit revenue and credit income summary to close out revenue. You're always going to debit income summary and close out credit expenses to close out expenses. Now, let's look at how do we close owner's drawings. That's another type of account that can be closed out. So let's look at an owner's drawings T account. Owner's drawings falls in line with expenses, which means they're always going to have a debit balance because owner's drawings will bring down the company's equity or the net worth. So let's say we have a $500 balance in owner's drawings. So therefore, if I want to get this balance to zero, the only thing I can do is to credit owner's drawings. Now, here's the little tricky part. Because you're thinking, all right, we closed revenue and expenses to income summary. I bet owner's drawings is closing the income summary. Actually not, because drawings is directly related to the owner's capital. We're going to close it to the capital account. So the overall goal, kind of two goals in regarding to closing entries. One is we want to get our accounts back to zero. But the other reason is that at the end of the day, if you're the sole owner of a company, you expect the profit to come back to you, which also means you expect if you take out any money, that's going to impact your investment in the company. So when you take out drawings, we now need to close that to your owner's capital account. Therefore, what that's going to do is reduce the amount of investment you have in your business. So owner's capital can only be decreased with a debit, which is appropriate since we have to credit owner's capital, owner's drawings to close it out. Right over here we said we'd have to credit it, which is what we just did. So when we're closing out drawings, and if you don't have a drawings to close out, then there's nothing to close. But if you do have it, you close it to owner's capital. And then there's one last step. Right now we have this income summary account. We had credited it for $10,000 and debited it for $3,000, which gives us a credit balance of $7,000 because the $10,000 is on the right side and it's the higher number and it's the difference between the two. Well, income summary, it's just a holding tank. And remember what I said, the overall goal is to get the profit to the owner. Well, my profit here is revenue of $10,000 and expenses of $3,000. That's a $7,000 profit, which happens to be this number. That's not a coincidence. Your balance of income summary will always be your profit. We want to get this profit to the owner. So in other words, I now need to close out income summary. I need to get it to 0. And the only way I can do that is by debiting it for $7,000. And since I want to get this profit to the owner, I need to move this profit to the owner's capital account. So we show here that I have to debit income summary for $7,000 to close it out, and then I'm going to close that, credit that to owner's capital for $7,000. So what we just did here, we just increased the owner's capital account, which is good because the owner's capital account is the investment that owner has in his business by $7,000. So we moved profit to his business. And that is the set of closing entries. So we're going to look at that BAE extra practice problem I posted last week in the solution, and do the closing entries for it as well. So that way you have an entire problem from start to finish, which will help you for your Mark Davis assignment. So let's go to that problem here. So last week you had the solution, everything from the impact on the accounting equation, the journal entries, the trial balance, and the financial statements. So now what we want to do is close out this company. So let's go to the T accounts. The only T accounts we will close out are the following. I'm going to put them in yellow here. Revenue, because that's a temporary account. We're going to close out cost of goods sold expense, because it's an expense, wages expense, and owner's drawings. These are the only accounts we're going to close. And we're going to do the closing entries right on this page. All right, so let's close revenue first. We have a $17,000 balance. I need to get this down to 0. So the only way I can get this down to 0 is by debiting revenue for $17,000. So once again, my closing entries is going to be done in red. So I'm going to go over here, type revenue, and let's just kind of get this set up. And debit it for $17,000. But remember, I got to move that somewhere. So where am I going to move it? I'm going to close that to an account called Income Summary for $17,000. So let's go up here and create an Income Summary account. So I have officially now put that $17,000 in Income Summary. So I have closed revenue. Let's do the next one. Let's close the expenses. We need to get each of these expense accounts to 0. So how I'm going to do that, I'm going to credit both of the expense accounts. All right? But once again, I got to move them somewhere. So let's just go down here. I know I'm going to credit both of these accounts. And I'm going to credit them for the $6,000 of cost of goods sold and the $2,000 of wages expense. But I'm going to move them to Income Summary. So I'm going to debit income summary for $8,000, which is the sum of the expenses. All right, so 3 of the 4 accounts highlighted in yellow is closed. So let's close owner's drawings. I need to get the balance to 0. Owner's drawings, we don't have to move it to income summary because it's already part of the owner. He took money out. So we can just go ahead and close it to owner's capital. So we had to credit owner's drawings, let's do that first, for $1,000. And I'm going to close that straight to owner's capital for $1,000. Now, the last thing to do is to close income summary, because this is a temporary account as well. The $17,000 is higher than $8,000, which means my balance is going to lie here on the credit side. The balance is simply going to be the $17,000 less the $8,000. So I have a $9,000 balance. I need to get this account to 0. So the only way I can do that is by debiting it for $9,000. Also, this $9,000, if I go and look at my financial statements, is also the same dollar amount as the net income on the income statement, which will always be the case. So I'm going to close income summary by debiting it for $9,000, and I'm going to move that money to where it belongs, which is with the owner, to owner's capital for $9,000. And that, my friends, is the set of closing entries. So this is a very short lecture, but I really encourage you to go back, do some reviewing on journal entries, trial balance, financial statements. So it's kind of supposed to give you a little bit of room to kind of catch your breath, get caught up here a little bit. The attendance phrase for the day is PINK, P-I-N-K. Hope you have a fantastic week, and I will talk with you soon. Good night.